Short call option. When to use a trade like this, you believe that the market is not going up. The strength of your belief determines what strike prices you should sell. Sell an out-of-the-money call higher strike prices if you believe the markets are not going up. Sell at-the-money options at the current price if you strongly believe the markets are not going up. And you can sell an in-the-money option below the current price if you really know something and then the market's going down. You can determine your level of risk plus your profit potential on the strike price you choose. The potential profit is limited to the premium collected. Your break-even point at expiration equals the strike price plus the premium collected. The trade profit is maximized if the market expires below the strike price. Your losses increase as the market rises. In other words, if you're wrong. This type of trade has similar risk to being short a futures contract from the strike price. Above the break-even is equivalent to being short the futures contract. At expiration, your losses increase by 1 point for each point the market moves above the break-even point. Having unlimited risk, these positions need to be watched closely. Here we're looking at August pork bellies. And based on your technical analysis, you see the market breaking down, and it should head further lower. So you feel comfortable selling a 92 call, especially in consideration that the market's at 85.50 or 7 cents below. Now this trade will lose money if the market's above. You take the premium of 2.3 cents and add it onto the 92 cents, and you get 94.30. So in other words, if the market's at 94.30 or lower come option expiration, I can't even get it to 94.30, but let's just pretend that line's at 94.30. Anyway, here's your line in the sand, 94.30. Anything below 94.30, this trade will return a profit. So you can actually have the market go back up, and as long as it's not, in this option expire in the money, and still make money on the short call option. Okay, so anyway, you collect. Well, let's see what you collect. We haven't got filled yet. Actually, the market goes down again. You only collect $744 or a penny 86. So you actually have to move your break even down to 93.86. Okay, anything below this line now will definitely return you a profit. Anyway, your profit potential is limited to the amount you collect. In this case, $744 minus commissions. Okay, you subtract commissions when you get money. You add commissions when you pay money. And it's limited to that amount. 28 days later, the market sells off and your 92 put is now worth $116. Now, a lot of people do something like this. They'll follow the market down and keep selling premium as the market breaks support. 28 days later, the market's still going down. And so on and so forth. Now remember, whenever you have short options on the table and they lose 90% of what you make 90% of what you sold them for, you should always buy them back because markets can come back. We'll leave these two options on and see what happens. Oh, the market continues to go down. Ooh, but look at this. See, if you didn't get out and it started coming back, some of these options actually come back to life.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and training techniques by industry leaders. This should not be considered as a solicitation to buy, sell, or invest in securities, options, futures, or Forex. Remember, trading does involve the risk of loss. Past performance is not indicative of future results. Stocks, futures, options, and Forex trading is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.